Assalamualaikum. Hopefully all are fine in this pandemic situation. Welcome to online class. Today I'll be discussing about illustrations of ratio analysis, and this course is entitled for honors first year and degree first year. In our previous classes we have learned there are four types of ratio analysis: liquidity ratio, solvency ratio, activity ratio, and profitability ratio. Okay, today we will discuss about the liquidity ratio. Liquidity ratio. A liquidity ratio is a financial ratio that indicates whether a company's current asset will be sufficient to meet the company's obligations when they become due. Okay, that means in your organization you have current assets, non-current assets, current liabilities, and non-current liabilities, and these current assets, how much ability of your current assets to meet up your current liabilities, that means current obligations, and it will be measured by this liquidity ratio. Here there are 5 forms of liquidity ratio. Number 1, current ratio. Number 2, liquidity ratio, and super quick ratio, and working capital ratio, and cash current liabilities ratio. Here current ratio is a popular ratio, current asset by current liabilities, and there will be the standard 2:1. It means that if your organization have 2 taka current assets and subsequently you have 1 taka current liabilities, it means that your organization is sound in terms of financial aspects. Liquidity ratio, liquidity asset minus liquid liabilities, and its standard is 1.1. that means your liquid assets, if your liquid assets 1 taka, then your liquid liabilities will be 1 taka, and it will be the good indicator. Super quick ratio, cash plus marketable securities divide current liabilities. Working capital ratio, working capital divide current liabilities, and its standard is 1:1. Cash current liabilities ratio, cash divided by current liabilities. Here there are some workings. Current assets means summation of cash, bank balance, account receivable, notes receivable, inventory, prepayments, that means advances in expense, accrual revenue. Current liabilities is the summation of bank overdraft, accounts payable, notes payables, proposed dividend, provision for income tax, accruals expense, that means expense in due, unearned revenue. Liquid assets means current assets minus advances, that means prepayment expense plus inventory. Liquid liabilities, current liabilities minus bank overdraft. Working capital means current asset minus current liabilities. So here these are the workings that must be addressed while solving the problems. Here there is the illustration, that means current ratio, current asset minus current liabilities. So current assets, here the current assets is cash and cash equivalents, account receivables, inventory, and current liabilities here is accounts payable. So after dividing, the result is 1.33. that means if you have 1.33 current assets available to meet up 1 taka current liabilities. And this is the quick or acid test ratio, current assets minus inventory divide current liabilities. Here current assets available here 910,000 divide current liabilities, it is about 1 to 0 0 0 0, and the ultimate result is 0.88. and in this way you can find out the other remaining forms of liquid ratios. Okay, thank you. We will solve more mathematical problems in our next class. Thanks for watching video.